Good morning, everyone. Am I audible? Can someone confirm me through the inbox? Or you can just say but unmute. Okay, thank you. There was a feedback. Okay, let's start the class. So I hope you all are safe, even though death numbers as well as the new case numbers are increasing or threatening our life. So there is no other choice. Actually, we have to adjust to live with the COVID. So having that note, I'm moving to the today's class. So I like to reiterate our general arrangement. If you have any questions or any comments, you can send it through inbox, or you can unmute your microphones and directly ask from me at any time. Even when I'm teaching, even you can stop me and ask the question. So I'm okay with that, because I expect that interaction in the class rather than I just telling something and you all are listening and going. So having that note, I'm moving to the today's class. Today we are in the second class of the risk management topic or subject. The last class we have discussed about the what is risk. We have started the risk management topic with the question that what is risk, and then I gave an answer that it's an adverse impact, probability of adverse impact, and the deviation from the actuals or the actual deviation of actual from the expected return is called the risk. Then I just discussed about what is risk management, and in the risk management we have discussed about the risk management process. There are 4 processes I have explained to you all: identify the risk, assess the risk, control the risk, and monitor the risk. So under that we have seen the 4 risk management process, and then we have classified the risk into different category, mainly the financial risk and non-financial risk. The financial risk, of course, it's very clear. There are 3 risks can be clearly called as a financial risk. First one is credit risk, second one is liquidity, and third one is market risk. And non-financial risk, of course, there are several risks we have discussed about the non-financial risk. And then we have discussed about the particularly with related to the non-financial risk, we have discussed about the 4 causes and 3 losses. Then from up to that point, we have discussed in the last class, and I have stopped the class with that, and I'll say that okay, the balance will be covered in the next class. So I'm going to start the balance slides. Okay, do you all have any questions in this regard? Anything the last class or previous classes, if you all wanted to ask from me, you all can ask. Okay, then since you all don't have the questions, I just for a clarity, because I am always like to get some feedback, because my job is related to risk management, my profession. So I'm always expecting some feedback, whether okay, everything is going on track. To check that, I'm going to ask a simple question from you. The last topic I have discussed with you all 4 causes and 3 losses with related to the operational risk. Okay, let me know what are those 4 causes that could create an operational risk. What are the 4 causes that could create an operational risk? Can someone answer that? You can unmute the microphone, or just even through the chat box you can answer. What are the 4 causes or 4 reasons that could create the operational risk particularly? Yeah, exactly. The people, procedure, system, and external event. This student answered the questions. I'm happy that. So there are four the four causes that could create an operational risk, which could be people or procedure or otherwise the system, then external event. And the three losses could be financial losses or reputational losses or failure to achieve the objective or business continuity losses. So these are the, up to this point we have discussed about it. Now I am going to move into the risk management framework. Actually, we put a sort of very foundation, very strong foundation on the risk management. Now we are going to move into the some other structural thing on the risk management. So one of the structural thing is the risk management process. So the first question, as usual, first question, what is risk management process? Generally, you can simply understand the risk management framework, which is sort of structure to build up the risk management process. So that is called risk management framework. So in a financial institution, it may be bank or finance company or any other financial institution, definitely there will be a risk management function. Okay, to carry out that risk management function, there will be a structure. Okay, structure in the sense there will be sort of a system and procedures and some policies and everything, governance structure, everything including the structure, which is called risk management structure. So as a definition, if you see that a risk management is a structure process used to identify the potential threat to the organization, to define the strategy for eliminate or minimize the impact of these risks, as well as mechanism to effectively monitor, evaluate the strategy. This is called the risk management framework. So you can simply understand that in a bank, there may be risk management, in a bank, there may be risk management function. Okay, there may be, definitely there will be a risk management function in each and every bank, because it's one of the regulatory requirement. So under the risk management functions, there will be a risk management committee or risk oversight committee, and there will be a sort of risk management department, and there may be several other structures to monitor the or to identify the risk, then assess the risk, and then organize or to find out the strategy to eliminate or minimize the risk, and then finally to monitor the risk. There will be some structure. So that structure is called the risk management framework. Okay, then normally it include the risk management framework include risk governance. The risk governance, generally the board of directors are responsible in a company, in any function. The ultimate responsibility will be board of governance or board of directors. So that board of directors will be part and parcel of the risk governance. And then there will be a risk oversight committee. We will discuss that later on. The risk oversight committee. The risk oversight committee is maybe one or two directors may represent that risk oversight committee. Other than that, the risk management department officers and some operational level officers also will get involved in the oversight committee, and the risk oversight committee also will be under the risk governance. And there will be a risk appetite. Risk appetite, of course, we will discuss later on. That is sort of a very important thing in a risk management process. So that every bank or finance institution may have different risk appetite level. So we will see about what is risk appetite in later on. So that risk appetite also will be part of the risk management framework, and then risk management process. So each and every bank or financial institution may have different process to manage the risk. So that risk management process, risk documentation, risk infrastructure, and risk culture of the organization, everything will be a part of the risk management framework. So you can just imagine that the risk management framework is a sort of structure including everything with related to the risk management function of a bank and financial institution, which is called risk management framework. And this picture will explain to you all this risk management framework. As I mentioned already, the risk governance and oversight will be as a top in the risk management framework. So as I mentioned already, the board of directors will be. What do you mean by the risk governance or risk oversight? They are the people, they may have sort of oversight or sort of governance structure. They may have the ultimate responsibility, and they will in charge to the entire risk management function of a particular bank. So under that, the board of directors will be, and then the risk governance framework, the board of directors will be sort of a top level risk in the risk governance, and they are the ultimate responsibility for the risk management function of a particular bank and financial institution. And then actually the board of directors may be the ultimate responsibility for each and every function of the company, but they may not get involved in the each and every function. Actually, what they will do is they may delegate their powers and duties to the lower level. So under that, the risk oversight function is coming. So they may appoint a committee called risk oversight committee, board risk oversight committee. So in a bank, you may see that the board risk oversight committee, and in that committee, one or two board members will be there. One board member will be the chairman, preferably non-executive board member, and then there may be a risk management committee, a risk management department head, chief risk officer, and other 11 parties will be in the oversight committee. So all these people, all these structure, including the risk governance and oversight. Have you all understand? Or do you have any questions from us? Because it's a simply, you may understand that in the top level of the bank and financial institution, the board of directors and board oversight committee will comprise the risk governance framework of the risk management framework, or risk governance of the risk management framework. Okay. I have, when I am explaining to you all, I have used a word, the non-executive director. Actually, we will see this non-executive director in detail in the corporate governance section. But before before going to that, having some understanding here, what is the meaning of non-executive director? Can someone answer me? What is the meaning of non-executive director? Because when I am saying that risk oversight committee, preferably the one non-executive director should be the chairman of risk oversight committee. I told you. Okay. So what is the meaning of non-executive director? You can simply unmute the microphone and answer, or you can send the answer through chat box. What is the meaning of non-executive directors? Generally, the directors can be divided into two. Generally, or very broadly, we can divide the directors into two categories: executive directors and non-executive directors. We will discuss this in very detailed manner in the corporate governance. Before discussing that, just to have an understanding here. Because I say that non-executive director should be the chairman. So what is the meaning of non-executive director? Can someone? This is sort of general knowledge, students.
Directors who are appointed by the majority of shares, the person who's having majority of shares, are being nominated as non-executive directors?
Yes, no, actually the directors are appointed by the majority of the shareholders. Actually, the non-executive directors and executive directors are divided based on their involvement in the day-to-day businesses.
Okay, sir.
If any director involved in the day-to-day business, that director is called as a executive director. If a director does not get involved in the day-to-day business, then that director may call as a non-executive director. Generally, in the bank, CEO may be one of the director. CEO will be executive director. But generally, I'm saying generally, the chairman will be the non-executive director. Chairman will get involved only the policy level decision making, but he or she may not get involved day-to-day operation. So that, because why I am explaining to you all here, because the risk oversight committee, there should be a non-executive director in the oversight committee, because if an executive director will be in the chairman, then he or she may influence the risk management functions. For example, DGM credit. DGM credit is one of the director. Okay, he or she will be considered as a executive director, because he is as a DGM credit, he will get involved always in the credit function of the day-to-day function of the bank. Okay, let's assume the scenario, the DGM credit, he is the executive director. He is the meantime, he is chairing the risk oversight committee. Okay, then the risk management department highlighting some risk, import or significant risk in the credit risk management function or credit management function. Sometimes the DGM credit may not like to escalate that risk to the board level, because he or she may get involved sort of a conflict of interest, because as a DGM credit, he may not like to highlight those risks to the top management. So he may put that sort of barriers, or put the break that, okay, we need not escalate that risk and we can manage and all sort of. So to avoid those circumstances, it is preferable and non-executive director should be the chairman of risk oversight committee. That's what I am just explaining to you. Because if it is a non-executive director, he or she may not get involved the day-to-day function. So he is freely he will freely escalate that to the top management or particularly board of directors. So that's what it is preferable be a non-executive director, be a chairman of risk oversight committee. In the central bank, of course, we are having board risk oversight committee. In the board risk oversight committee, one of the monetary board member, particularly the appointing member, there are three appointing members. They are considered as independent members. So one of the independent member will be in the chairman of board risk oversight committee, BROC. So likewise, in every bank, there may be some oversight committees, risk oversight committee. Non-executive director will be the chairman of the oversight committee. I think you would have now cleared that the understanding of the what risk oversight committee, why there should be a non-executive director, the chairman of this risk oversight committee. Any questions you all wanted to ask? Yeah, actually, there are answers also. I failed to visit. The not involving the day-to-day operation, but possess the special knowledge. Yeah, exactly. And person who is giving the independent view on the running businesses. Exactly. That's the thing. That not involving the day-to-day operations are called as a non-executive director. Okay. Then in the risk management framework, first at the top level, the risk governance and oversight will be the place. And the second one is risk appetite. The risk appetite is most important word or most important thing in the risk management process. Because before deciding everything, before assessing the risk, before finding the solution, or before controlling the risk, before monitoring the risk, before everything, the bank should decide their risk appetite level. So what is the meaning of risk appetite level? The risk appetite level means each and every bank and finance institution, they may decide, okay, this is the level that particular bank can take the risk, that the risk level which a particular bank willing to take. For example, in a bank X, the risk appetite level may be 5 billion. Sometimes bank A, they may have the risk appetite level 25 million or 25 billion, 25 million. So up to that level, they are ready to take the risk. For example, the risk appetite level of the bank X is 5 million. So when they are making a risk, when they are making an investment, if they find that, okay, there is a risk more than 5 million level in that particular investment, then they may not go for that particular investment, because their risk appetite level is 5 million. Maximum, the risk appetite level means the maximum risk particular bank is ready to absorb, ready to bear in a particular financial year. So that is called risk appetite level. So if it is a 5 million level, they will decide, okay, whatever the risk below 5 million, they may ready to take that risk and make the investment or grant the loans and advances. If the risk capital, whenever the risk appetite level low, that particular bank and finance institution may not take higher risk. If the risk appetite levels are high, then the particular bank will take higher risk. If you can see some finance companies, they are ready to take higher risk. They are not ready to, their business model is like that. They take more risk, and they may grant the loans and advances to the more riskier sector, and they right to earn more money, but they're ready to get the more risk also in their business model, because their risk appetite level is high. This is the risk appetite level may depend on the institutional culture, or may depend on the particular board of directors willingness, and their willingness to take the risk level and all. There may be several factors may get influence to decide the risk appetite level. So in the risk management process, the first as a first function in any financial year, the bank, the board of directors, or particularly risk oversight committee, has to decide what is the risk appetite level for a particular bank and finance institution for the particular year. So based on that only, they will decide each and every other things. But what would be the controlling mechanism? What would be the follow-up mechanism? And everything will be decided, be based on the risk appetite level of the particular finance institution. I think you will have now the clear understanding about the risk appetite level. Is there any questions you wanted to ask? Because this concept is sort of tricky concept. So if you will understand, then then it's easy to just understanding other things. So the government, the particular bank or finance institution which will decide the governance structure. Then after the governance structure, they will decide about the risk appetite level of particular banks. And after the risk appetite level, based on the risk appetite level, they will decide the risk management process. The risk management process, they will do the risk identification and risk measurement and risk control, risk monitoring. These are the risk management functions, and then risk analysis and reporting. Actually, you can get a simple understanding. In some banks, okay, in the teller, for a teller limit is decided based on the risk appetite level of the particular bank. Okay, but it doesn't mean the teller limit is the risk appetite level, but the risk appetite level is as a whole risk appetite level will be there in the bank. Based on that, okay, the particular bank may decide, okay, this if a customer withdraw more than 500,000, the teller has to get the approval from the second officer. But some other bank may decide, okay, it may be 1 million. Because it is depend on the risk appetite level of particular bank, risk appetite level of particular branch. So the particular bank may have overall risk appetite level. Based on overall risk appetite level, each and every branch, each and every functions may have different risk appetite level. That is the reason one bank may have 500,000 as a for the teller limit, or some other banks may have 1 million as a teller limit. So these are why there are difference, because these are based on the risk appetite level of the bank. It is different. So the risk appetite level and then risk management process, of course, I need not explain to you all this, because this is we have discussed in the last class. And then the risk documentation. That is also one of the framework. It's very important. Time to time, they have to analyze the risk, and then based on the analyze, they have to report to the top management and board risk oversight committee or risk management department. Likewise, there are several layers, so they have to report that risk level to the escalate to the top management. So in that each and every process, the risk documentation is important. And other than that, there may be other documentation also. This risk policy, there should be a risk policy, risk management policy. Each and every bank should have, finance institution have risk management policies, which has to be documented. And the procedures, internal procedures, which has to be documented. So risk documentation is important. And then risk infrastructure. That infrastructure, in the sense, there may be risk management department, and then there may be some flows on that, how risk should be escalated and all, which will help that risk, which will include that in the risk infrastructure. And then the risk culture. Actually, the risk and complaint should be like a culture. It has to be created as a culture. That's why I have already told you that in some finance companies, they are taking more risk because they are risk culture. They are risk takers. Their culture, risk culture is like that. Their business model and risk culture is like that. They are taking more risk. But some risk culture is okay. They are very. They don't take much risk, and their risk level is very low, and they don't go for a risky businesses and all. They are playing with a very comfort zone or very safer zone. They are playing with a very safer zone. Their business model is like that. So the risk culture is also part and parcel of the risk management frame. So if I sum up this risk management framework, this diagram. So the risk governance is the first one. Then they have to decide the risk appetite, and then risk management process get involved. Then risk documentation based on the risk analysis and risk reporting, and the risk infrastructure. Finally, everything is depend on the risk culture of the bank or finance institution. This is about the risk management framework. Do you have any questions?
Sir?
Yeah.
As you said that finance companies, they usually take high risk. But in recent past, we saw that so many finance companies are getting bankrupted. So it might lead to a uncertainty in the market, right? So, but even if we take finance companies, their market penetration is a bit or somewhat lower than the banks. So, is it a good sign?
No. Yeah, I don't say it's a good sign. Even I have mentioned you all that some finance companies are taking more risk. Some finance companies are not taking more risk. And other thing is this finance companies business is sort of risky business. As I explained to you in the last class, there are formal financial sector and informal financial sector. Then this formal financial sector, normally formal financial sector customers are catered by the banking sector. And informal sectors are, there may be local money lenders, and everybody is in the money lenders and relations lender. Now all these informal sectors will be polymudalale. This type of things will be in the informal sector in the rural level. So these finance company play a role as a bridge between the informal sector and formal sector. So naturally, they are getting involved. They are dealing with the highly risk customers. Generally, when you are seeing their portfolio, banks are sort of not dealing with such a highly risk customers. For example, leasing customers, and even though bank have the leasing, the microfinance, and even these people are the finance companies are granting loans, the microfinance for a very rural areas and without any collateral, and it's highly vulnerable sector, highly vulnerable sectors. And those who could not reach the bank easily, they are just as a second option, they are coming to the these finance companies. Okay, their business itself lead to them to take more risk, but I'm not saying it's a good sign. That has to be controlled. That has to be controlled, and there should be adequate resources to monitor these finance resources to manage the finance companies. And my personal opinion, this is not my institution view, my personal opinion, the main issue in the finance companies failure, main issue is lack of capital. They don't have adequate resources to run them in a companies. That is one thing, lack of capital. Another thing is the decision making is concentrated into particular group or particular person. There is no proper diversification of the ownership. These two are the main, and so which lead to the corporate governance issue. So these are the main issue for the failure of finance company. This is my personal view. And this dealing with the high risk customers also naturally lead them to high risk. But this is dependent, because one thing you should understand that, okay, why they are try to deal with the high risk customers, because whenever there's a simple theory, whenever there's a high risk, return should be high, but it's again risky business. So there to some companies to achieve the higher return, or to get the higher return, they are trying to get the high risk. But I agree with you that that's not a good signal, and they have to have a good risk management function, or they have to have at least good resources. The last slide talking about that is base capital. They should have the good resources, capital, to absorb any unexpected losses created through this risk. Any other questions? Okay, then I'll move into the different risk management framework. Now, so far we have discussed about the risk management framework. I have explained to you all that risk management framework is sort of things which are including all the related to the risk management function of the particular bank. And there are different risk management frameworks in the banks. Even you could see in our Sri Lankan banking system or financing system as well. The first one is traditional risk management framework or silo-based risk management framework. Other one is integrated risk management framework or enterprises risk management framework. The silo-based risk management framework, particularly I'm explaining to you all the silo-based risk management process. In that silo-based process, actually, there will not be a centralized risk management department in the finance institutions. So the risk will be, there will not be sort of risk management committee even. So what will happen is actually the risk will be managed by the particular divisions separately. For example, the credit risk will be managed by the credit division or credit department, the particular banks or finance institution credit department. And they may not have the connection with other treasury operations. So treasury operation risk will be managed by the treasury operational department on a silo base. They may not have the connection with the credit department with respect to risk management. And then again, the branch management will have separate risk management framework or risk management procedures. Likewise, within a finance institution, different divisions may have different risk management procedures and all is called silo-based risk management. There will not be any centralized risk management department which will have overall view of the risk management. Okay, and as a flip side of that, so a silo-based risk management system, there's another risk management system which is called integrated risk management system or enterprise risk management system, where there will be a centralized risk management department and there will be a chief risk officer. He will be a overall in charge for a risk management function of the particular bank and finance institution to certain level. Okay, so you can just have a simple understanding. Silo basis, the separate divisions have separate risk management frameworks. But in the enterprise or integrated risk management, for an entire institution, there will be a risk management department. Under that risk management department, the risk management functions of the entire finance institution will be get coordinated. That is the two different the risk management framework. Understand? Okay. The silo base again, it's actually I have explained to you. Anyhow, this slides giving some idea to silo base. Organizations have traditionally used silo based approach. Yeah, I just wanted to I forgot to tell you that traditionally or sometimes before, all the institutions followed the silo-based approach for the risk management function. But nowadays, the risk management functions are become as a moving to the from silo-based approach to integrated risk management approach. So there will be a risk actually in Sri Lanka also, the central bank supervision department issued a direction called integrated risk management direction. Accordingly, every bank should have independent risk management, integrated risk management function within it. So there should be a central division called risk management division and all. So that's what here it says that organizations have traditionally used to silo-based approach to risk management that looks the individual performance of a business unit instead of more holistic approach that looks the long-term impact on risk and capital needs of the entire enterprise. On top, as an opposite, the enterprise risk management is a new and evolving management discipline that has changed along with the corporate and regulatory landscape of the last decade. And the enterprise risk management is the process of planning, organizing, leading, and controlling the activities of the organization in order to minimize the effect of the risk on the organization capital and earning. Actually, in the risk management functions, first we are identifying the risk, and then we assess the risk, and then we are controlling the risk, and we are continuously monitoring the risk. And I told you, the risk cannot be eliminated totally, because there will be some involvement in the even maybe close to zero, but there will be some amount of risk get involved in any transaction or any activity of the banks. So what they can do is, so they can't totally eliminate it. So there should be there will be some low level of risk. Definitely there will be some low level of risk in any transaction. So what they can do is, they can maintain resources to absorb those unexpected losses. So which is organization capital. So that's why even the Basel document and everything emphasize the banks to maintain the adequate capital. So we will discuss that later on. So here the organization, the risk and minimize the risk and effect related to the organization capital and earnings. Another thing is, as I mentioned already, risk and return is always sort of the two sides of a coin. And enterprise risk management include financial, strategic, and operational risk, in addition to risk associated with accidental losses. A good indication of that company is working with the enterprise risk management is the presence of the chief risk officer or manager designated to coordinate the enterprise risk management. That's what I say, that if it is an enterprise risk management framework, there will be a centralized risk department, risk management department, and there will be an officer called chief risk officer. That chief risk officer will be in charge for the risk management function, to coordinate the risk management function of the banks and financial institutions. So this is one of the diagram which will explain to you about the enterprise risk management and in a very broad way. So as I mentioned, in the enterprise risk management, first they will decide the risk appetite, and then they will, based on the risk appetite, they will decide, okay, maximum, what is the risk level they can reach, the maximum risk level, and then they will go for a risk identification in each and every transaction, and then risk assessment and analysis. They will, based on the risk identification, they will assess, okay, what would be the risk likelihood and impact of particular risk, identify risk, and then they will go for a risk mitigation and controls. So once they okay, then okay, this is the appetite level, this must be the risk assessment or impact, and what would be the risk mitigation to minimize the risk level, and then they will decide on the emergency preparedness and responses, and they will go for a business continuity planning and exercising, BCPs, and the process improvement and training, and risk reporting and monitoring, and risk consciousness and organization resiliency. These everything include the enterprise risk management framework of the bank and finance institute or any organization. Okay. BCP, of course, there are questions on the BCP, the business continuity plan, which even nowadays it's most important in any institution, particularly financial institutions. Have you all heard about it, or do I need to explain to you all in detailed manner? Or if you have understanding already, I just skip and going to the other section. I have, shall I repeat the question again? I asked you all that I have one of the process. I have explained to you all that business continuity planning and exercising is one of the enterprise risk management framework component. And if you already have the understanding about the business continuity planning, then I can skip that if you have the understanding. But if you wanted to explain me, I can just explain you some little bit more and go to the other section. You all wanted me to explain. Yeah, okay. There are requests that to kindly explain. Actually, the business continuity planning is one of the planning, business continuity planning, in the sense, if there are some disaster may occur suddenly, or there may be some fire, or even natural disaster or man-made disaster may occur in our business environment. For example, there may be tsunami, or for example, there may be flood, or there may be terrorist attack, or even we can say there may be pandemic. Okay, that may disturb the business continuity of the particular institution. Okay, for example, if there are tsunami or the terrorist attack or anything, then they can't continue, that there will be a disturbance in the particular business of the bank and finance institution. So to face those type of incidents and smoothly continue the business activities of the bank and finance institutions, every banks and finance institutions may have business continuity planning under their contingency planning arrangement. So what they will do is, they will, for example, okay, for example, if a bank which has a business continuity plan, okay, suddenly there's a flood, or that suddenly there's a tsunami or something, the particular bank could not function their activities in the particular place. So they may have the disaster recovery site in the sense, they may have other arrangement where they can function the particular bank function from that site. For example, if we take a central bank has the business continuity plan. If there are some interruption in the business, okay, there's a disaster recovery site in the central bank, which are in other places out of the Colombo. So if they cannot function in their businesses or their activities in the head office, suddenly they will move the officers to the particular site, disaster recovery site, and from that site onwards, they will run the banking business. Likewise, every bank may have the disaster recovery. So they may have the all the information, backup information and all. So if something goes wrong, they will just run in from the other institution. For even you need not to think about that such a large event. For example, your all the informations are passing through some cloud provider, cloud information provider. Sometimes if there are some breakdown in that supply of that particular cloud information provider, so the bank should have another arrangement, should have some other arrangement to provide the cloud, so to get the backup data and continue their business. So that is called business continuity plan. Every banks and finance institution should have business continuity plan. So in any disaster occurs, they should have a backup plan to continue the particular business of the particular bank and business activity without any interruptions. To the extreme scenario, recently actually there was one of the foreign banks, they request the disaster recovery site out of the country, because they say they think that, okay, if something happened to the entire country, if there are some conditions which prevent the works in the entire country. So they should function the particular bank operation or particular activity from some other country. Even they should start at the operation. So they are in the Western world, they are thinking about in that way. Even but in our case, of course, our disaster recovery may be out of Colombo or some regional level and all. But in some in the Western countries, they are having disaster recovery even out of the country. So if something happened to that country, stop that function and start all the function from some other country and continue their businesses. So that is called business continuity plan. Any doubt, or you will want anything? Okay, this business continuity plan also one of the part of the enterprise risk management function. So each and every bank or finance institution, if they must have the enterprise risk management, and under the enterprise risk management function, they should have the business continuity planning as well. So that is one of the part. Another thing is process improvement and training. The risk management training is important, and risk reporting and monitoring, and then organization resilience in the ultimate objective. So this is about the risk management function. If you have any questions, I can give you some time to ask the question. So otherwise I can move to the sort of a new topic called 3 lines of defense, which is also involved with this enterprise risk management function, but some other concept, this sort of new concept. So if you have any question, you can ask, or otherwise I can move to the 3 lines of defense. Okay, since there is no questions, I am moving to the 3 lines of defense risk management. Actually, in the risk management, I have already explained to you the framework. Under the framework, there are 2 types of framework: silo-based framework and integrated risk management framework. Under the silo-based framework, each and every divisions will have separate risk management function, so that there will not be an integrated risk management function. But other side, opposite to that, there's an enterprise risk management function where all the risk management activities of the particular bank and finance institution will be connected. And under that, there will be a centralized risk management department, and under the centralized risk management department, the chief risk officer will coordinate the risk management function of the particular bank and finance institution. And connected to the centralized risk management function or enterprise risk management function, there's a model called 3 lines of defense model, which explain among the risk management functions are divided among the three lines or 3 group of people to manage the effective management of the risk. For example, if you see the war front, if you heard about the war front, in the war front there may be bunkers. Okay, if the two country the armies are battle each other, then in each side there may be bunkers. Okay, in the bunkers there may be different defense lines. So first line of defense. So there's a first line of bunkers, and if something happened, then they may come to the second line of defense. So if something the opponent or the enemy country capture the first line, then second line people will get effect, started their attack. Then there may be third line of defense. Likewise, in the risk management function also, there are 3 lines of defense which will safeguard or which will get involved the effective risk management function of the particular bank and finance institution. For even in our body, you can see that. Okay, our cloth will be the first line of defense from the disease or any attack. For example, if even you can simply say that. Okay, this mask is one of the good example I can give. The mask is there are 3 layers. Okay, this first layer. So there's a more defense lines. 3 layers in the mask. If you see the surgical mask, there are 3 layers in the surgical mask. This every layers may be first line of defense. Okay, is something these viruses are even they just entered from the first layer, it will be defended in the second layer or third layer. So there are 3 lines of defense. Likewise, in the risk management function also, there are 3 lines of defense. We will see what is the 3 lines of defense in the risk management function. Okay. This diagram will explain to you the 3 lines of defense. For example, I can before understanding this diagram, I can give you an example. In a branch, okay, particular branch, we'll take a particular bank X have a branch in Anuradhapura. Okay, so in the Anuradhapura branch, there are some risk happening, some risk in the operational risk. Okay, some cash, there's a shortage of cash or some risk is happening, so they are handling the cash transaction in the particular branch. Okay, so in the particular bank, in the particular branch, the branch manager level, there should be some controls, there should be some procedures. Okay, if they are handling the cash, they should follow particular procedure in the particular branch level. Okay, in the particular branch level, the branch manager will be in charge to the particular the particular cash handling things, and he may have imposed several controls for the cash handling, and he will monitor that particular controls are implemented in effective manner in the particular branch, and whether these cash tellers are following that cash handling things and all. So those people are considered as a first line of defense at any branch level. So any risk management or risk management related control which are implemented in the branch level or front office level, which is called first line of defense. Okay, so the manager of the branch manager, operational manager should look after whether there is adequate control and that controls are implemented. So that is called the first line of defense. So what is the second line of defense? Okay, in the branch level, he may have the particular internal controls and monitoring, but in the second level, in the risk management department, centralized risk management department, they may have certain unified internal control system to handle the cash in any branch. They may issue some particular circulars, some guidelines. Okay, when you are handling the cash, you have to follow this type of internal controls. They may create some policies related to risk management of the cash handling, and they may issue they may issue some guideline to handle any of the branch, not only Anuradha branch. It may be Kandy branch, it may be Matara branch, any branch. They should have certain policies to handle the cash. So that is called second line of defense, centralized risk management department. And other than that, centralized risk management department time to time monitor whether this branch manager is doing their job properly. Okay, so the first line is the branch level. The branch manager will be in charge for that branch level first line of defense. Then the second line of defense, centralized risk management department, they may have they may issue the policy document, as well as they may monitor time to time. They may monitor whether these risk management things are happening. If there is any breaches, then they have to escalate to the governing body or the board risk oversight committee. So that is called second line of defense. And third line of defense is internal audit department. So they are giving independent assurance that based on the policies, risk management policies, all their internal controls are followed by the branch people, and they are everything is up to date. They have to give an independent assurance to the top management is called third line of defense. Okay, now you will may get an understanding. The first line of defense is the branch level or front office level. They are in charge for the management controls and internal control of any business activities. They are the internal control, the front office people. And the second line of defense, generally centralized risk management department, and there may be compliance department, there may be credit controller department. Likewise, generally the risk management department and compliance department is coming under the second line of defense. And there may be, for example, if a credit also, there may be centralized credit monitoring divisions. If there is a centralized credit monitoring division in a particular bank, that centralized credit risk monitoring division also will be considered as a second line of defense, because they are just okay, all the documents will be credit related documents will be scrutinized in the level, but they also will have sort of second line of defense. They will recheck. But generally, if in an exam, if there is a question, what would be who will be the second line of defense, you will have to say risk management department, compliance department. And the third line of defense, the internal audit people. So they will give an independent assurance to the top management about the all the internal controls and risk management policies are properly implemented in the financial institution. So these are called three lines of defense model in the risk management. The first line, second line, third line. If some risk are okay, it has not been captured in the first line, then second line of defense will give a safety. And then if it is not captured in the second line, even the third line will capture. These are three lines of defense model. On top of these three lines, nowadays they are talking about the fourth line of defense also. Who are the fourth line of defense? External auditor people and regulators will be the fourth line of defense. Time to time, they will go to the bank and check whether all the things are improper. So they become the fourth line of defense. Okay, now you can understand that first line of defense, second line of defense, third line of defense. As a first line of defense, operational manager own and manage the risk. They are the people in the operational manager of a particular bank or front office. It may be treasury front office, or it may be treasury office, or it may be branch, or anywhere. The operational manager own and manage the risk. They are the people ensure that all the internal control systems are implemented. And they also are responsible for implementing corrective actions to address the process and control deficiencies. Operational managers or business unit is responsible for maintaining effective internal control for executing risk and control procedures of the day-to-day business. Okay. And then it's a second line of defense. In the real world, a single line of defense often can provide inadequate. The management establishes various risk management and compliance functions to build and monitor the first line of defense. So second line of defense is sort of building the first line of monitoring the first line of defense, and function the second line of defense will vary by organization and industry by typical function of second line of defense. So it includes the risk management function that facilitate the monitoring the implementation of risk management practice and operational risk. That is the second line of defense. And third line of defense, internal auditor provide the governing body, the senior management with a comprehensive assurance based on the highest level of independence and objectivity within the organization. This high level of independence is not available in the second line of defense. Internal audit provide assurance on the effectiveness of the governance, risk management, and defense. So these are the things again which I have explained to you about the first line, second line, and third line of defense. Okay. Any questions you wanted to ask from me? Because this is sort of new concept. Sometimes you may face difficulties to understand it. If you all wanted to ask any questions, I'm ready to answer. Okay, just for as a feedback, I'm asking a question from you all. Just give an answer. Who is the first line of defense? Who is the second line of defense? Who is the third line of defense? If you all understand the which I have explained to you all, you can easily give the answer for that. Who is the first line of defense? Who is the second line of defense? Who is the third line of defense? It's a one-word answer. First, shall we start with the who is first line of defense? Yes, the branch manager. Actually, the business unit or branches will be the first line of defense. If there is any questions in the exam paper, who is the first line of defense, you can say the branch manager also correct, but the precise answer will be the branch or business unit will be the first line of defense. Then who is the second line of defense?
Risk management department and compliance department.
Yes, exactly. The risk management department will become the second line of defense. And compliance department also part of the second line of defense. In some banks, risk and compliance functions are carried out by the same department. But some banks, if it's a large banks, there are two divisions, separate divisions. One is handling the risk management functions alone, and the other division handling the compliance function. So you can say the risk management is a precise answer. Even you can tell compliance function as well. Who is the third line of defense? Audit. Exactly. Audit department. Internal audit is the third line of defense. Okay, because why I'm again and again asking from you all is because there are questions about in the past paper questions asking that there are questions that who is the third line of defense, who is the second line of defense. And other thing is here, I think it's better to explain to you all at this point. Okay, we have studied that there's a first line of defense, there's a second line of defense, there's a third line of defense. Who will have the more independency? Whether, because independency means without interference of the management people, without interference of the top management or management people, not top management. Top management means not to the order, this this top management means the not in the
Third line of defense means internal.
yeah, third line of defense have more independency. They are the people giving the independent assurance to the top management. So, and compared to first line of defense, second line of defense have somewhat more independency, but less from compared to internal audit or third line of defense. And first line of defense, of course, having very low level of independence. So if there is any question in the exam paper, who will order the level of defense lines based on the independency. So the first line will have the internal auditor, or first line will have the more independency, and risk management department, centralized risk management will have the independency less than the third line, but more than the first line, and first line of defense will have the lower level of independency. So that is the order. Keep it in mind. Okay. So if you'll have a clear understanding, then I can move to the other section. Any questions? Okay. Now we have first we have studied about what is the risk management, and then risk management process, and then we have discussed about the internal financial risk management, and then non-financial risk we have discussed about it, and then we have discussed about today we have discussed about initially we have discussed about risk management framework. And then we say that there are two types of framework. One is silo-based framework, another approach. Other one is integrated risk management approach. And under the integrated risk management approach, we see that there are 3 lines of defense model. Okay, that's a concept called 3 lines of defense model, and that it is for to manage the risk. Okay, now we have put a sort of very, very strong foundation on the risk management. Now I am going to explain to you a little bit further about this financial risk management function. I have mentioned your 3 financial risks. What are those 3 financial risks? What are the 3 financial risks? Yesterday at the last class, I explained to you all that the financial risk can be categorized into 3 areas. That there are 3 areas precisely we can tell. What are those financial risks? There are 3 risks can be called as a financial risk. Yes, exactly. Credit risk, liquidity risk, or market risk. So these are the 3 financial risks. Now I am going to explain to you all about that financial risk management, the financial risk related management. First of all, I am going to take your credit risk management. There are some specific areas we have to cover. The first one is, I have already explained to you all, the credit risk can be considered as a default risk and concentration risk. Okay, the default risk is, it is a chance of companies and individuals will be unable to make the required payment on their debt obligations. For example, if a bank, what is the default risk? If a bank grant the loans and advances to the particular customer or particular company, in that case, what is the chance that particular company or individual will be unable to make the required payment on their debt obligation time or due date? That is called default risk. Okay, and then when you are based on the default risk, you are deciding the default premium. Oh, banks and finance companies are deciding the default premium. What is the default premium? It is an additional amount a borrower must pay to compensate a lender for assuming default risk. Before explaining this, I'm just asking you, You all heard about the prime lending rate. Weighted average prime lending, the average weighted prime lending rate, AWPR. The central bank every week we are publishing average weighted prime lending rate, AWPR, in our economic indicators. Every week, Friday, we are publishing. Have you all heard about it?
Yes, it's more like per week the interest rate calculated for the high net worthy clients by banks.
Yes. Yeah, exactly. They are just these are the rates each and every banks, maybe HNB or commercial or BOC or any banks, they may grant the loans and advances to highly net worth customers or highly the credit worthiness customers, at a lower rate. Okay, those rate has to be reported to the central bank. Then central bank, what they are doing is they are averaging and average weighted is, and they are announcing, okay, this is the average weighted prime lending rate, which is the rate is considered by very low rate. Okay, so since you all are working in the banks and finance institution, I need not too much explain to you all. Okay, then other customers are coming, or generally customers are coming. This bank will decide the rate. So bank will offer the rate to the customer, saying that, okay, 2% above the prime lending rate. Okay, that 2% is the default premium. Okay, then this the particular bank consider that, okay, this man is not the prime customer. There may be some premium we wanted to keep this man because there are chances to default by this customer. Okay, then they will say, oh, if it is a fairly good company, then prime lending rate plus 1%, prime lending rate plus 2%. It may increase 3-4%. If it is a prime lending rate with the plus 5%, that customer may be somewhat risky customer. So the default premium is, it is the additional amount a borrower must pay to compensate a lender for assuming default rate. Okay, that is the concept called default premium. So additional amount the customer has to pay to the bank to compensate the default risk. And then how to estimate the default risk? Default risk could be identified through the rating report or rec record or cash flow statement performance of similar industry. You can see the default risk. Of course, I can just give an example. If it is a insurance, if it is a tourism companies, now you may expect that default rate risk may be high for those companies because the tourism companies are facing the issues. So generally, you may heard about the NPL ratio, the non-performing loan ratio, which is close to the default risk of the particular bank. If it is the NPL ratio, how the NPL ratio is calculated is non-performing loans divided by total loans and advance. Actually, there are different calculations for the NPL ratio calculation. There are gross NPL ratio and there are net NPL ratio. Particularly, we can say the gross NPL ratio, there are two ways. One is non-performing loans divided by the total loans and advances. Other one is non-performing loans minus interest rate suspense divided by the total loans and advances. And then net performing loans is NPL ratio is non-performing loan minus interest rate suspense minus specific provision divided by the total loans and advances, which is too technical. You need not to, for the exam point of view, you need not to worry about those things, and for the knowledge you can just have an idea. Okay, so estimating default risk, we can through the NPL ratio, we can past NPL ratio, we can estimate the default risk of the industry. I have already said that the credit risk can be divided into the two: default risk and concentration risk. The default risk, we have said the particular customer or company which could not pay, make the payment on the due date. And the concentration risk, which I think I have explained to you in the last class, it is a level of risk in a bank's portfolio arising from the concentration to a single counterparty or sector. I think I gave an example to you all. One bank grant the loans and advances to 10 customers. Other bank grant the loans and advances to 500 customers. Obviously, the bank which granted loans and advances to 10 customers will have high concentration. A bank granted to 500 customers will have less concentration risk. And other than that, of course, sector-wise concentration also we can measure. For example, if a bank they may grant entire loans to tourism sector or manufacturing sector or apparel industry. Some banks or other bank granting the loans and advances to all the sectors: consumption purpose, tourism, manufacturing, retail trade, and there are many this retail trade and financial service, etc., etc. So in that compared to first bank, this particular second bank has a less concentration, because even one sector does not perform well, other sector customers will pay on properly. So that particular bank will have less credit risk. Understand? So concentration risk can be measured or estimated through the ratio the loans and advances to a particular sector divided by total loans and advances. For example, Bank A, which granted out of their 500 million portfolio, they granted 250 million into tourism sector. So the concentration ratio would be 50%. 250 million divided by 500 million. So 50% of the concentration risk would be 50%. So concentration risk could be mitigated through diversification, which they can divert to the different banks, different customers, different sectors and all. That is called about the concentration risk. And country risk also, which is not applicable for domestic banks, but if it is an international banks or global banks, country risk is applicable. If a particular bank, global bank, grant the more loans and advances to particular country, then it has the country risk. For example, sometime due to some political reasons, they may freeze the payments, or they may announce that don't transact with particular country customers or particular country. In that case, the particular bank may expose to the country risk. So it means the concentrating into particular country. It is applicable for a global bank. Not if it is a domestic bank, of course, they have to grant the loans to the particular country. So if it is a Sri Lankan bank, they can grant for the Sri Lankan customers. But if it is a global bank, if they concentrate into one country, they may face the issue. For example, a global bank which granted more loans to North Korean customers, then due to some reasons, political reasons, they put the sanctions. So that bank may face the issues. So there are actually in each and every risk we have to see the mitigations. So there are mitigation factors. Carry out the proper credit evaluations. So to mitigate the credit risk, they have to evaluate the proper evaluation in the sense credit rating, or some banks may have internal rating system or anything. So they have to do the proper credit evaluation. Obtain valuable collateral. That is one of the bank. I think our banks and finance institutions are more keen on getting the collateral. In the foreign countries, of course, they are granting loans based on the cash flow. But in our banks, of course, that is one of the more one of the allocation on our banking system that they are highly rely on the collateral. So that is one of the mitigating factor, and diversify the portfolio. Rather than giving to particular sector, particular customer, diversify into several customers. Making loan loss provision. The loan loss provision also one of the way they can mitigate the risk, in the sense if some loans are going default category, so making the provisions. There are two provision: general loan loss provision, specific loan loss provisions. I think general loan loss provision in the sense whether it is non-performing or performing, they may make some percentage of provisioning. I think in Sri Lanka maybe 0.5 or 1%. General loan loss provision they have to make. Specific loan loss provision based on the category of the loans, they have to make certain percentage, 20%, 50%, 100% provisioning they have to make. So this is making the provision, loan loss provision also is one of the way to mitigate the credit risk. So before going to the related party transaction, if you have any question, you can ask. Okay, I just ask the questions, just to get your knowledge. In a bank balance sheet, which risk is highest risk? We are just talking. We have discussed about the credit risk, liquidity risk, market risk, and then operational risk, strategic risk, legal risk, and all sort of risk. We have studied about so many risks. Okay, so in a bank balance sheet, or for a particular bank, or for a banking business or finance company business, which risk is the highest risk? And why? And why? Come on, students. This is some general knowledge. For a banking business, okay, we have discussed several things. I am repeating the questions. We have discussed several risk categories: credit risk, market risk, liquidity, and all. For a banking business, which risk is the highest risk? Or for a bank, which risk will be highest risk the particular bank exposed? Just guess, students, you can guess that. Yes, of course, there are two answers. One answer is market risk, other answer is credit risk. Of course, I may say that credit risk is the highest risk, because if you see the bank balance sheet, more than 70% of the assets are represented by loans and advances. Okay, those assets are subject to credit risk. The loans and advances are subject to credit risk. Okay, then more than 70% of the balance sheet are subject to credit risk. So in any bank, the highest risk would be the credit risk. Okay, this is just for a general knowledge, but sometimes it may related to the questions also. So just keep it in mind. So credit risk would be the highest risk for a bank. That's the reason that if you see this Basel I, now we are implementing. We have already implemented the Basel III, but when you are talking about the Basel I, which purely concentrate on the credit risk, and it required a capital for a credit risk, because in traditionally we considered the credit risk would be the highest. Even now also is the highest, but they gave the much prominent to the credit risk. That's why the Basel I is talking about the credit risk mostly. So the credit risk would be the main risk for a bank. Just for general knowledge. Okay, then we will move into the other topic, which is related to the credit. risk, but some different topic. Just I'm like to include in the with the credit risk, because there are questions in the past paper. That's what I just read. The related party transaction, which is very famous and which is in accounting standard, and this regulator, the Central Bank of Sri Lanka, is much concerned about these related party transactions. Accounting body also required to disclose it. The related party transaction is a transaction that takes place between two parties who hold pre-existing connection or common interest prior to the transaction is called a related party transaction. The accounting standard defines that a related party transaction is a transfer of resources or services or obligation between the related party, regardless of whether a price is charged or not, which is considered a related party transaction. So what does it mean? It generally, simply, we will understand the concept simply and all. For example, if a bank grant loans and advances to the related party, there are some definition for the related party. For example, they are granting loans to the board of directors. One of the director, they are granting loans to the one of the director, board of directors. They are granting to the spouse of the board of directors. They are granting the loans to the spouse of the CEO. Or they are granting the loans to the main shareholder of the particular bank. Those are considered as a related party transaction, because before the transaction, even they had a pre-existing connections. Because as a director, that particular person has a pre-existing connection with the particular bank. Then you may ask the customer also, if they have the if they have the account, saving account for 10 years or any other accounts with the 10 years, they may also have the existing connection, of course, but as a customer. Not only as a customer, some other way, if the two parties have the pre-existing connections, and if any transaction take place between the two pre-existing connected people, that transaction is called related party transaction. That is a simple understanding. And in the related party transaction also, nothing wrong in the related party transaction. Okay, they can bank as a normal business, they can grant the loans to the director. They can grant the loans to the spouse of a director or CEO. They can grant to the loans to the other major shareholder. There is nothing harm. But the problem is there may be preferential treatments. Since they have the pre-existing connections, there may be preferential treatments with related to particular transaction, which is considered as a violation. The first thing is granting accommodation to the related party at a preferential manner. Preferential manner in the sense, the market rate is going to the say 12% or 11%, but they are granting, or 9%, now is 9%. They are granting loan to 7.5%. Since he is a director or he is a spouse of the director, they are granting. So that is a preferential treatment. And charging the low interest rate, or granting the preferential manner in the sense without getting collateral. Okay, for this type of customer, they are normally getting collateral. Okay, if it is a personal loan, they are getting the guarantee, but without getting guarantees or anything, they are without any proper evaluation or anything, they are granting the loans, which is the preferential treatment. Paying more interest for deposits. Okay, if the one of the director or large shareholder deposit with a bank, but paying more in deposit rates. Providing favorable terms, waiving the fee and commissions. Okay, that also be considered as a preferential treatment. Another thing is, for example, they are they are purchasing some software from the director's related company. The director has a other company, own company, software company. So this bank purchased the particular software from that company without any tender procedure or without any evaluations. That is considered as a preferential treatment. So there are some preferential treatment. If there are preferential treatment to the related party, that could be considered as a concern. And to avoid that, but the accounting body says that, okay, you have to disclose the preference and the related party transaction as a one of the note item in the accounts. Okay, so they have to, then during the year, they have to make this type of transaction with the related party. They say that the proper disclosure may avoid any preferential treatments. And the SEC, as CBS issued guideline on related parties, and the SEC also issued code of best practices on the related party transaction. Actually, related party is one of the area there are the questions frequently questions are coming. So better just understanding this, and we will discuss about the related party in the corporate governance also. You can add on the knowledge even that area also. So this is about the related party transaction. If you have any questions. Okay, liquidity risk management. We have discussed about the liquidity risk already, but this is about the liquidity risk management, where we can divide the liquidity risk into the two sections. One is funding risk, liquidity risk, market liquidity risk. The funding liquidity is the possibility that bank could become unable to settle obligation with immediately in the maintenance is called funding liquidity risk. That means a particular bank, this is not a market issue, particular bank could not have adequate liquidity to meet their obligation. So payment due is called funding liquidity risk. The funding liquidity risk could be managed bank through the maintaining statutory liquid asset ratio. How many of you all heard about the statutory liquid asset ratio? The statutory liquid asset ratio is a ratio. It's a ratio calculated by the banks. Okay, how much of liquid assets they are having against their liabilities. Okay, each and every bank has to maintain at least 20% as a liquid assets in their total lab. For example, if their total liability is 100 rupee, they have to maintain 20 rupee as a liquid asset in the liquid asset form. Okay, for example, what are the liabilities in the banks? The deposits may be liability, borrowings may be liability. Okay, they are having 75 rupees, 75 million deposit and 25 million borrowings. So altogether they are having 100 million liability. Out of the 100 million liability, they have to maintain 20 million as a liquid assets. Liquid assets in the sense, it may be treasury bill, treasury bond, SLDB, or cash in hand, those type of liquid assets. So by maintaining this liquid asset ratio, they can avoid this funding liquidity risk. Or otherwise is maintaining the maturity gap analysis. Maturity gap analysis in the sense, which is sort of gap analysis. Each and every banks may have assets flow, cash inflow and cash outflow. Okay, so they are calculating the difference between the inflow and outflow. By calculating that and finding whether they are, make sure that their inflow is higher than the outflow, they can avoid the funding liquidity risk. And SLAR requires the bank to maintain minimum liquid asset to meet their obligations. Nature of the banking business create maturity mismatch and thus liquidity risk. Okay, this is one of the other important area we have to see. There are questions. There were past paper questions. The nature of the banking business itself create a liquidity risk. Please explain it here. So there may be questions like this. Nature of the banking business create maturity mismatches. Please explain the statement. Okay. How do you say that the nature of the banking business create a maturity mismatches? Is it so? Is it true or false? I'm asking you the question, nature of the, yes, true. Yeah, exactly. It's true because the nature of the banking business, generally, the banking deposits are 1 year or less than 1 year, generally. Most of the banking deposits are, the contractual maturity will be 1 year or less than 1 year. There may be product for 3 years, 5 years, but very less number of customers deposit for 5 years or 3 years. Most of the customers keeping their deposit in the 1 year category, 1 year or 6 months or 3 months, less than 1 year category. So in that case, the nature of the business, they are getting their funding source, the short-term funding source. But the most of the bank grants their loans and advances for long term, 5 years, 3 years, over more than 1 year loans. Okay. In that case, if it is a housing loans, it's a 15 years, 20 years housing loans. But whereas they are getting the deposit for less than 1 year or 1 year, maximum 1 year. So in that case, the banking business itself create a maturity mismatches. The funding sources are short term, but funding usages are long term. So this nature of banking business create maturity business. So that also will lead to a liquidity risk. So to avoid that, what the bank has to do is, bank has to calculate the maturity gap analysis in a proper way. They have to manage their cash flow, and on top of that, they have to maintain the statutory liquid asset ratio, and by maintaining that, they can avoid the liquidity risk or funding liquidity risk of the bank. Any questions? Okay. Actually, I like to complete the slides. That's why I'm just going on somewhat fast. If you wanted to ask any questions, just stop me, because last 3-4 classes I'm just I could not complete the slides. That's what I'm just run through. The liquidity, market liquidity, I say that liquidity risk is as a two-part, the funding liquidity and market liquidity. The funding liquidity for a particular institution, particular bank and particular financial company, they does not have adequate liquidity to meet their obligations. But market liquidity, it is an inability to sell and exit from a particular investment. For example, okay, bank has a liquid assets. The bank has I have already explained to you, bank has treasury bonds, but it's a 30 years treasury bond or 20 years treasury bonds. Let's assume 20 years treasury bond. They could not sell that treasury bonds in the market. So it's very rare, very difficult to sell that investment without losing the capital, or without losing the value, real value. So that is called the market liquidity. It can be in the treasury bond or it can be real estate. For example, bank may own the real estate, but they suddenly they can't sell the real estate and make it cash, because okay, tomorrow they need the money, they can't sell the real estate. So these type of because this is due to the market inefficiency. However, due to adverse market condition, it can only be sold at the fire sale value. Yeah, that also I have discussed with you all. Okay, they can't sell it at a reasonable price, but if they go for a fire sale, they will. But when the liquidity defined, it has to be converted. Any asset, it can be converted without creating a loss. That it can be easily converted to the cash, which without loss. that could be considered as a liquid asset. So if it is a real estate or long-term treasury bonds, could be an issue. And measure to mitigate the liquidity risk, maintain the minimum liquid assets, and improve the cash flow projection. Perform the stress testing to forecast the unusable liquidity requirement, and contingency funding arrangement could be the one of the measure to mitigate the liquidity risk. What does mean in the contingency funding arrangement? Other three we have already discussed about. Contingency funding arrangement. I think the contingency funding arrangement, it's a two finance institutions. They may have the agreement. Okay, they may have the agreement. For example, if bank A may have the agreement with the bank B. Okay, if there is any urgent liquidity requirement, you have to provide the liquidity up to this level, up to 500 million. You have to provide. Okay, they will use that facility in an urgent situation only. Okay, but for that they have to pay as a commission or some fee, 3% or something they may pay. Okay, to get that facility for 1 year. So they may enter into the 1 year agreement. Okay, within 1 year, if I have any urgent liquidity, you have to provide 500 million without collateral or anything. They will just have an agreement. Okay, those type of arrangement is called contingency funding plan. Okay, any contingency situation, they just take it that any urgency, they will take that fund. So those type of arrangement also one of the measures to mitigate the liquidity risk. And maturity mismatch, of course, we have discussed about that. Banking business by nature exposed to maturity mismatch, which we have discussed now, and liquidity and solvency. These are two concepts. I think last class I have explained to you all. It's again and again it's coming to the exam. So keep in mind. They are just in the short note. They are asking the compare with the liquidity and solvency. I have already discussed with you all the solvency risk and liquidity risk. We have now discussing. So what is the liquidity risk? Liquidity refers to the ability of a firm to mobilize assets and use them to meet its obligation, and mainly it is a short-term concept. The liquidity risk is the inability to a firm to meet its obligations. It is a short-term concept. But solvency is a refer to the bank overall positive net worth of the bank is not adequate enough to its overall financial obligations. The main difference is it is related to the long-term position of the particular bank and finance institution. The difference between the business ability to use its assets to meet its obligation in short-term and long-term. So if there is any question, you may have to answer these 3 points mainly. You have to elaborate based on these 3 points about the liquidity and solvency. And again, the liquidity risk management, we have, I think if you all are working in the bank, you all may heard about that ALCO, Asset and Liability Committee. In every banks, I think connected to the treasury operations, they have ALCO committee. Asset and Liability Committee is a decision-making authority responsible for balance sheet planning, the asset and liability planning, the balance sheet from the risk return perspective. Also, they are the simple understanding. Asset and Liability Management Committee is a committee in charge to the deciding the interest rate as well as liquidity of the particular bank. Okay, they are the people, strategic management of the interest rate and liquidity risk, they are the people managing. They are having some functions or roles and responsibilities of the ALCO to ensure the efficient implementation of balance sheet management policies, to review the reports on liquidity and market risk management, to review the deposit and loan product pricing strategy, to determine the correct assets and liability mix to minimize the profits and to ensure suitability of funding arrangement for managing maturity mismatches. Actually, there were questions you'll just keep in mind, and this is very straightforward, these functions. I think I need not too much explain to you all about it. So I just these are just you can read and understand about the ALCO. And finally, we are moving to the market risk. Market risk, which we have discussed already, we have mentioned. The market risk has several other risks. Other sub-risk. One is interest rate risk, price risk, equity price risk, and commodity risk and exchange rate risk. There are main components. The interest rate risk is a possibility of declining the value of an asset resulting from unexpected fluctuation of interest rate, which I have already discussed with you all. That means if due to the fluctuation of interest rate, if the value of the assets, financial assets are declined, then which is called interest rate risk. You can when a particular bank and financial institution invest in the treasury bonds or debenture, they may expose to this interest rate risk. Whenever the market interest rate going up, the value of the securities will come down. There are inverse relation. There's an inverse relationship between the interest rate and the value. So that is the risk to the finance institution. So what are the strategies? Actually, if it is a market risk, there may be two mitigation. Generally, you can just write it. The investment first is diversification. Second one is using the hedging strategies will be the mitigating the interest rate risk exposed by the bank. And equity and price risk. Equity price risk is it's again the fluctuation of market prices could expose to the value of the portfolio. The decline in the value of the portfolio create an equity price risk. Equity price risk could be there are two type of equity price risk. One is systemic risk, other one is unsystemic risk. The systemic risk, unsystemic risk means particular share price will decline. So they may have the problem. But systemic risk means entire stock market get crash. Okay. So generally for a unsystematic risk, what you can do is you can diversify the portfolio. For example, rather than invest in the one company or 3 companies, you can invest in the 10 companies or 15 companies or 20 companies. By doing that, you can mitigate the unsystematic risk. But if it is a systematic risk, of course, again you have to diversify, but different way. You have to diversify into real estate and commodity and bond market. Likewise, you have to diversify the portfolio. And exchange rate risk, of course, which you know that the particular bank or financial institution exposed the risk due to the fluctuation of foreign exchange rate. The foreign exchange rate means the rupee-dollar exchange rate or rupee-euro exchange rate. Due to the fluctuation of the exchange rate, bank may exposed to the risk. Actually, currently, the country is exposing to the exchange rate risk highly. The forex liquidity, banks are facing the forex liquidity, and recently there were rating reports mentioned that the banks exposed to the forex risk. And commodity risk, of course, there are commodity fuel, gold and all. So when the global market, the commodity prices are fluctuating, the bank exposed to the additional risk. For example, if a bank invest in the gold and the global gold prices are fluctuating, then bank may expose to the commodity risk. So these are the called commodity risk. I think that's all about that. And finally, we have the risk-based capital, which I'm covering the next class. This is one slide. I think it has to be understood in very, very detailed manner. So better I'm covering into the next class. So we have discussed about today, in the today's class, we have discussed about the risk management framework, and then enterprise risk management and 3 lines of defense. And in the financial risk, I have explained to you in detailed manner the credit risk management, liquidity risk management, and market risk management. I think in the latter part of the class, I have just rushed through the slides. If you have any doubt, you can ask. Actually, due to manage the time, I just rushed through the slides in the latter part. If you have any questions, please ask me. Otherwise, we will meet tomorrow's class. Any questions you will want to ask? Because this is again, we have already discussed these 3 risks, and these are, you can just read it and get the idea. Yeah. Anything you will want to ask from me? Okay. Since you all don't have the questions, I'm stop the class at this point. And next class, of course, next class I will discuss about some theory up to the 1 hour or 1.5 hour. I will discuss about the theory, and after the balance 1.5 hour, I will discuss some past paper questions. Then you can so with the one in addition another 1 hour, I can complete the theory part. Then we will discuss about the past paper. Then you can get some idea about what type of questions are coming later to the risk management. As you mentioned, for exam point of view, this is one of the important topic. Okay. We'll meet the tomorrow. If you have any questions, just go through the slides again. If you have any questions, please come up with the questions. I'm ready to explain and take the time and explain to you all. Okay, good luck.